A good 90-minute conversation on financing the way forward, where we'll discuss the roles of various institutions, including the development bank, the public finance institutions, and of course, some of the de-risking tools that can be used to crowd in larger flows towards infrastructure generally and green infrastructure specifically. So to my extreme, to my left is Robert Youngman. I'm not going to be reading out their bios because they will be flashed on the screen, so I'm just going to give you their title and organization affiliation. And when they speak, you will see their bio on the screen. Please read that. So I have Robert Youngman, who's the team leader for green finance and investment at the OECD Environment Directorate. We have Dhruba Purkayastha with the Climate Policy Initiative. And I think you've flown in for this particular meeting, or are you Delhi-based? Great. Kanika Chawla, who was recently curating one of the finest renewable energy dialogues in New Delhi. She works in a nifty boutique institution which focuses on environment. Nifty, and not the exchange, but the adjective. so she works on environment. She's been working on environment and on the renewable energy sector for a while. We have Rathin, who's probably one of India's finest minds on matters finance and generally in the public finance field. He heads the National Institute of Public Finance and Policy and is a member of the Economic Advisory Council to the Prime Minister of India, and he of course has also been associated in many of our previous efforts, both leading up to Paris and thereafter on the climate finance sphere. And finally we have Pankaj Verma, the Associated Director who works on environmental issues at the IDFC Bank. So I think we have a good spread of academia and institutions on this particular panel. And I will begin with Rathin, just because he happens to be my favorite speaker in this particular sector, and I'm going to go to him first to set the tone and tempo. So I'm going to ask him a broad question, but of course Rathin will certainly make it broader and more specific both at the same time. So Rathin, what is the role of development banks in financing infrastructure projects in the emerging world specifically, and how is public finance and development banks working together? How are these two different strands cooperating to create a new ecosystem for growth and for infrastructure in this part of the world?
Let me not disappoint you and start with your second question and answer it in 2 words. They are not. Okay. In any substantive measure, and I can elaborate on that later in the discussion, but in my view they are not. There are initiatives, but you said, are they cooperating institutionally as an ecosystem? They're not. Okay. The first question. Well, I think there is now a recognition which was not there even in the lead up to Paris. I mean, you will remember that both public finance institutions, and I presume you mean multilateral and bilateral development banks, are not going to be able to generate ever the volume of finance that is necessary to meet the infrastructure challenge as economies emerge, if they continue to emerge, notwithstanding the President of the United States. And if that is the case, then they need to redefine their role a bit. And there were 3 levels of ambition, I think, along this journey. The first, I think, the development banks have recused themselves from, in the sense, right from the IMF, the World Bank, etc. They have recused themselves from the rather simple macro-fiscal challenge that the total annual increment to the stock of global savings is more than enough to meet infrastructure needs where they are, if the money were to go there, but it's not going there. We know that, so there's an allocation failure. And underlying that allocation failure lies a metric of calculus of political and institutional risk, which overstates such in many developing countries. It's much worse for Africa than it is for India, but it is there. And therefore the challenge, which was to find ways to reduce this political institutional risk, has not yet been met by these developing banks. And the public financial institutions, insofar as they interact in Basel and the G20, there's not much action here. There's a lot of talk, but there's not much walk. There is one exception to this, which is the brave New Development Bank, which has expressed its understanding that rating agencies, we were talking about this earlier, are a major part of the problem, because they have emerged both as market makers and as people who are part of the regulatory infrastructure, as providers of regulation information. So that bank and that bank alone has at least expressed its intent to try and do something about it. But that bank is beset with many, many other problems, so it is rather unfortunate that this has not gathered momentum elsewhere. The public finance institutions have a particular problem, developing country public finance institutions, which is one of schizophrenia today. I would not have said this a year and a half ago. The schizophrenia is as follows. After the 2008 Atlantic financial crisis, the pressure to undertake greater and greater volumes of macroprudential restrictive regulation, rather than incentivizing actions to improve macrofiscal performance, so that the sorts of write-offs and Schumpeterian destruction of capital we saw, principally due to the failure of the economists amongst you of the efficient markets hypothesis and its complete sort of dethroning from the sort of axiomatic world of finance, meant that the developing countries were at a disadvantage because, and these are the major, with the exception of the US, the major demanders of this kind of money, because what they actually needed was money at cheaper rates and more of it. And macroprudential regulation is about less money with more restrictions. Very fashionable amongst the environmental people here. Good example is Basel, that Basel should actually put in environmental safeguards. So we were grumbling about it, and we continued to grumble about it, and many developing countries did, but then we had a banking crisis in the developing countries, particularly my own, which led in fact to demands for even more macroprudential regulation there. So public finance institutions, ministries of finance, central banks, while understanding the global nature of the problem, are now caught between a rock and a hard place. And in this country in particular, since we now know more or less that the problem we have with non-performing assets is largely an infrastructure financing legacy problem, the case for smarter macroprudential regulation as opposed to more macroprudential regulation, which incentivizes less lending and more of comfort with commercial paper, that argument is now firmly on the back burner. I don't think anyone in the Ministry of Finance would listen to me twice, or in the central bank, if I put this argument out today. So these are rather bad times. We have the need for investment in infrastructure, and then we need to do green. I'll say one more thing and stop. We are in a situation where actually, while the run-up to Paris, we were getting some footage. I remember certainly with AXA, you will remember many private sector players saying that, yeah, what we actually need is smarter macroprudential regulation, not more of it. The emerging markets themselves, Brazil, followed by India, began to have serious problems in their own banking sector. So the solution, as I'm looking at it now, not the solution, but a pathway out, is one, to recognize we can't wait indefinitely for the banking system to overhaul itself. Two, the stock of savings that I mentioned earlier is not going anywhere.
Correct.
It's not that we've seen a dip in global savings, of any magnitude. And therefore, perhaps the time has come, people are thinking of moving away from looking at how banks lend money to looking more at fixed income products. So a lot of attention is now moving to the development of, there's some froth on equities, but I'll still call it froth. I mean, again, there's some nice, I don't mind those studies, they're nice studies, and they're very well done, and I'm sure that they get tenure to the people who write them, or promotions in their banks. But they are not studies which have captured intellectual imagination at a scale where, across the difficult communities you deal with, the engineering communities, the finance communities, the treasury people, and of course the people who actually demand the finance, you need to have some kind of a cross-excitement there. I'm not seeing that happening. I'm seeing it happening to some extent when it comes to bonds.
Green bonds.
And there's a recognition that what we need to do is, in emerging economies like India in particular, I think of a couple of others, not all of them, which rely A, primarily on domestic savings, B, therefore view incremental foreign investments in fixed income as just that, incremental. And that is likely to continue now, given the very likely move towards, I think, some financial fragility in the world in the next year. That we have to somehow break down this barrier where, in times of stress, fixed income has become sovereign paper. So we need to have product that moves in two directions. One, in using sovereign paper to leverage non-sovereign investments in the assets that you want to see, using bond markets. And the other, to understand that one of the savings investment mismatches is that while there are investors who wish to invest long term, they need to have exit windows which are short and medium term in nature. So what we need is product between the long term paper that sovereigns are good at and the short to early medium term paper that people actually want to invest in, even if their intention is to invest long term. And that product at the moment is lacking. There are some exciting alternatives coming up. In the particular sub-area of this conference, I think green bonds is doing great. I've been following this very carefully for the last 3 or 4 years, and it is no coincidence that when your colleague Samir asked me whether on the 18th of July you're doing this, I said it will be difficult because this is Climate Finance Day in London. Everybody is doing green bonds there. India has actually been very successful in raising a 300 million railway bond in the London markets. It's worked well, and therefore I think there is appetite now for both an architectural conversation and a conversation about scaling up that is going to work specifically in the area of fixed income. So what I'm saying is banks are going to take a long time, in summary, to get their act together. Development banks have not risen to the institutional architecture challenge and are unlikely to do so given the quality of political leadership in contemporary times. That's quotable. And therefore, the hope is in non-bank financial product. Equity is exotic. There's hope there, but it hasn't matured yet. So where we are today is fixed income. Thank you.
Rathin, before I move to Kanika, I think let me ask you one more question, because you were part of the same committee which Ms. Kidwai was steering in producing that report. And she was here with us last evening, and I asked her a question which I want to repeat, and I want your response to that. The report calculates a figure, I think, if I remember correctly, of 305 or some number like that, $305 trillion of total global assets under management. That includes both long-term and a very small part is actually engaged on the key question of infrastructure and climate infrastructure. That was a report written in 2016, 2 years ago. 2 years down the road, have you seen greater participation? Have you seen a larger group of stakeholders beginning to participate? I'm not saying that you can cover the $305 trillion in toto, but have you seen a larger section of the asset owners engage on this?
No.
You haven't? No. Simple answer. Okay.
I haven't.
No, fair enough. Because
data available to me, I haven't.
So you've not seen any greater excitement from this segment. Great. So I think that takes me to Kanika, and I think one of the concerns, or Rathin has actually explained that the methods of assessing risk is something that perhaps needs to be relooked at. But till we change the way we price money and we appraise credit, how do we create certain tools and instruments that can give a degree of de-risking, that can achieve a degree of de-risking for certain kind of investments that we want? Because he's again quite sure that development banks and public finance institutions are not going to be able to meet the huge amount of flows we need, and private capital is likely to be still the most viable stream of money. That private stream of money does require some kind of de-risking product. And I think you have been thinking about this, so maybe you can expand on what, or you can add to what Rathin was saying and specifically tackle this issue of de-risking.
May I just add to what you said, Kanika, because I think your answer is going to be very interesting, with the one exception of looking at innovative ways where public money can be actually put to private purposes, notwithstanding the prudential and institutional safeguards that cause that public money to be deemed sovereign.
Okay.
Thank you. So actually I want to start with the green bond example, and I think I agree with Rathin that green bonds are a very interesting instrument for the sector that got a lot of attention as well, and in India we've seen a fair bit of success relative to other instruments. But I also think that it's important for us to realize that there's been a lot of noise around green bonds, often made by rooms like this one. And the reason for that is that we think that green bonds are going to be a silver bullet, and that green bonds are immune from the risks that other debt faces. Green bonds are important because we don't have enough debt in this country. The bank debt is the only source of debt that we have access to, and so any new source of debt is important, and new sources of debt will and as you have more sources of debt, it becomes competitive. You have, the cost of debt comes down, all of that. But A, we don't have a bond market in India that's thriving, and B, even within that very small bond market, we don't have an investor grade that rewards green. So in the domestic bond market, whether it's green, brown, yellow, blue, it really doesn't matter. If it is a Hero Future Energy bond, it's because it's Hero that people are going to buy it.
Correct.
If it's the Railway of India doing a bond issuance in India, which they have.
It's not the green that they are.
Exactly. But if you do the bond issue in foreign markets, again, there are risks that exist on foreign debt that would exist anyway. So Forex risk being the first and foremost, right? And so Forex risk covers exist. It's not like we want something innovative to come up, but they are prohibitively priced. So the minute you add that premium onto it, I may as well just borrow in domestic currency in my domestic market. And that's the role that I think that public money needs to play, because there isn't enough public money in the world to finance the needs of the world. And so in the context of Paris, since that's where you opened, there's been so much discussion around climate finance, around GCF money, and India has been branded obstructionist because we say that you must put the money into the GCF. But we're not really doing it for ourselves. Firstly, very little of that money is going to come to India. But even if all of the 100 billion came to India, it would be inadequate. So if all of that 100 billion came to India, what would I like to do with it? I'd like to use it to leverage private money. And that private money is not necessarily from banks, but private money that isn't currently coming into green infrastructure or into most infrastructure unless it's being built out by the government. And so for the sort of, hard to get heroine of the piece really is pension fund money or any other institutional money. And it is, how do I get access to that, and why is that it's so elusive for this sector? And the reason is because that it's a really good match in terms of tenures and timelines, but it's not a very good match in terms of the risk-return profile. In terms of the return profile, the renewables folks would love it, right? All green would love it because you don't have to pay back very high returns. But in terms of the risk profile, it's just far too risky to do green infrastructure with money that is from savings funds of like the teacher savings funds or pension funds or insurance funds. And that's where public money needs to be created. You need to create instruments that use government money to underwrite the risks for these. And it can't be in the form of really vague credit enhancement.
So investment guarantee schemes where you can underwrite pension funds investments into long-term infrastructure projects.
But that's my problem with it, right? Because we've heard a lot about credit enhancement. So we will give you blanket cover. And then what? We don't solve the moral hazard problem at all. And that's why we need to be innovative. We need to use public money for de-risking.
But the World Bank has actually dabbled with this. I think in certain projects in Latin America, they've actually come up with something called the MIGA, right?
Yeah, which is a political risk guarantee.
Political risk guarantee.
Yeah, which is not allowed to operate.
I mean, what I mean to say is we have done this. We have dabbled with products which have sought to do.
Obviously not done it effectively enough.
Correct.
And so that's why I think that we need to, and MIGA is not specifically for green infrastructure, and I think that green infrastructure needs fit-for-purpose vehicles, and perhaps I can talk about
I don't want to bring MIGA into this conversation. All I'm trying to say is that, let me go back to Rathin's point. Now, suppose, and I'm going to ask you this question, suppose we were to convince the regional development banks, since they know the region, to undertake that risk guarantee instrument. So, since they cannot fund the infrastructure needs of Africa, if the African Development Bank was to offer such regional guarantees for political certainty, regulatory uncertainties, so to guarantee investments by pension funds, is that a viable medium?
Absolutely, because the thing is, what happens is, for instance, I'm going to use the example of India. We have a growing risk around the integration of renewables into the grid. It is a risk that is not been created by the developers, and it's not something that the developers should have to bear. Right? But it is a risk that is in part of the making of either the government or government institutions and the transmission companies and the distribution companies and the power sector's failure in and of itself. That being said, if I were to use Indian government's money, whether whether directly through a domestic initiative or through a pooled initiative in which the NDB, where India puts money, I'm creating moral hazard for the government of India to then try and get their house in order so that they don't default on it. Otherwise, there's no incentive to not default on the guarantee.
And let me just make this more complex. So money, the risk becomes higher the minute you go down the value chain and reach the levels of the SMEs, the small and medium enterprises. So it's not the hero fund, but it's actually a smaller group. How do you see them being covered? Because if you're looking at micro solutions, efficiency solutions, energy solutions, smaller infrastructure, then you're beginning to tap into a whole new constituency of actors. How do you reach out? How do you reach them using any product available in the market?
Actually, I think that we've never really truly done an SME risk assessment because it's just the transaction cost of doing that is too high. So we don't actually know what risk to underwrite because I don't want to go and look into an SME. It's too expensive for me for too small an amount of money that they need. So really then, there is a role for public institutions. They need not be financial institutions, but for public institutions to do bundling and to do that sort of aggregation, so to speak, for these SMEs, so that then there is a IDFC that is interested and so that they can look beyond the SIDBs of the world. And this is of course very much in the context of India, but this happens everywhere. Decentralized solutions across Africa, decentralized solutions in Latin America, Southeast Asia, they're far more expensive than utilities.
So in a sense, the same thing that you're trying to do with the International Solar Alliance by aggregating a series of projects, some big, some small, some with risky countries, some with less risky countries, create a pool, create a pooled offering for financing.
Or a striated offering, at least bundle things that are off this, if they're all very bad projects, at least pool them together. I'm not even saying that you need to, we don't have
Fair enough. So you don't want to leverage one successful project on against a weaker one. I think that fits. Now we can go to Robert. And in a sense, you've heard two views from two different sorts of institutions working on this particular issue. Sitting in OECD, which is also a think tank of increasingly a larger number of countries, but let's say still largely it is catering to the developed world. How are you grappling with these key questions of unlocking more financial flows, of de-risking new actors from and encouraging them to enter into this sector? And of course, I think both of them have touched upon how do you whip up a bit of passion into this lazy money owners who are earning negligible or negative returns and are unproductively parking their capital in different sorts of projects. So I think sitting in OECD, what is the mood there, and what are the conversations happening there?
Hello. Thanks for the opportunity. So you set up the question very well. I'm going to step back and reframe just a little bit, but picking up on what the previous speaker said. So renewable energy is competitive in India. This is very good. This is very good news. Increasingly competitive. It's more competitive than 60 gigawatts of coal, based on a recent study by Coal Carbon Tracker. But financing costs need to come down to meet the deployment objectives, the current deployment objectives, and then the increased ambition objectives that were announced recently. So what are parts of the solution? It's quite complex. But breaking it down into a few areas might help. One is policy frameworks. Another is institutions and what institutions can do de-risking and what types of de-risking. And then thinking about institutional investors and what their role is, and getting at your question. So part of the solution, we think, in our work, and this is based on investing in climate, investing in growth, and other work that the OECD has done, is that it's not only core climate policies and energy policies that matter for mobilizing investment, it's broader investment conditions in a country that have a role that can create barriers. And this has been touched on by various speakers. And I would say, Kanika, you were saying this issue of moral hazard. And if there's an underlying problem, let's say, of creditworthiness and concern, perception that there's creditworthy, that the counterpart is not creditworthy, it's hard to get over that with any particular guarantee. You sort of have to address the underlying problem. So part of our work and part of this program that Geraldine talked about and Gabriella talked about, it's the Clean Energy Investment and Financing Program. And this is a program that would be supported by Denmark for 5 years. It's an exciting new opportunity to sort of bring our work on policy frameworks, but also in other areas, on institutions, on investment channels, on de-risking, on institutional investors, to work with partners here in India. And I hope that to talk with many of you about this program. But just briefly, the summary, the premise behind the program, like I said, is that this broader investment condition that works. And we've tested that out in econometric studies, just taking a look what actually across OECD and G20 countries actually has an impact on renewable energy, renewable power investment. And we found that in addition to confirming our views that carbon prices matter, that fossil fuel subsidy reform matters, that tenders are effective. Obviously, India knows this, and you're going to do perhaps a 100 megawatt auction, which is 10 times bigger than any that's been done in the world so far. Your costs have come down 80% since 2011. A lot of things are going quite right. But it also confirms some other things. This broader investment environment matters. Ease of doing business for solar PV, licenses, permit systems, ease of registering property, all of these have an impact on investment. So there's no one size fits all, and one econometric study is not going to show everything, but it can point to some areas where there actually could be impacts on investment that you want to address the underlying policy causes. That's part of this project that we want to work with ORF and others on. Other policy factors seem to be important. PPP frameworks vary between state and federal. From an investor perspective, how easy is it for them to understand these PPP frameworks? Do they follow best practices? Are any best practices useful at the state level, for example? Green securitization we talked about. It's a great way to refinance, expand lending. There's a tremendous reliance on commercial banks here for renewable energy and energy efficiency financing. That may continue in the future, even though you want to access other sources. Green bonds could be one way to do this. And in our study on green bonds, we found that with securitization, that actually is the
Don't
way
let Kanika
globally.
scare you. I mean, we heard that there is a degree of optimism
bit
around
scared.
green bond growth as an instrument.
Well, so this is just one way globally to scale up investment. Looking forward, we envision that if you can securitize, for example, EV batteries in a way that's appealing for institutional investors, aggregate them into green bonds, that's a way that the market could really grow and also create interest in this product that's tied to projects rather than the underlying balance sheet of a company. So that's a different financial product that could be of interest. So I talked about institutions. One type of institution that we've looked at is green investment banks. And this comes back to IRETA, just bring it back to, so we had K.S. Popley attend our event, our forum on green finance and investment in Paris last year. And he was on a panel on green banks. And he said, well, actually, we've essentially been a green bank since 1987 because we have a focused mandate, we direct support, we channel funds. And this is the question of whether institutions can play this role, can play a leadership role, can in a very strategic way use de-risking mechanisms and effective way to use them. So what we've seen in recent data collection, then I'll wrap up, but in collecting data, data is very hard to get at in this area, but for public financial institutions, we have 151 transactions in which public financial institutions crowded in institutional investment. And what we found, this is preliminary, so hopefully this is not way off, but we looked at public entities, and out of these transactions, you've got governments, you've got development banks, MDBs, and interestingly, the UK Green Investment Bank, which has since been privatized, was responsible for 64 of these projects out of 151. So just that could demonstrate the power of an organization that has a mandate to do this, a focused mandate, and that has expertise in this area. I can talk about the different instruments that they used. CPI has a lot of expertise in this area, and if we have this project, we'd love to work with you. Domestic investment is critical, and these are numbers that CPI and OECD came up with together. I think the last number was 79% of all financing into low-carbon infrastructure is domestic. And so, yes, we want to find ways to get international institutional investors investing in India, but at the same time you have domestic funds are critical and you don't have to deal with the currency risk.
I think you flipped the equation there. I think the equation is that it is kind of demoralizing that only 21% of climate finance crosses the border. And I think that is the challenge. I don't think there is a virtue in money investing in the location of its origin, but I think the challenge is of money crossing borders.
Okay.
And that's how you balance the savings, and I mean, that's the Rathin equation that he mentioned in the beginning.
I was anticipating a flip that I thought that you might make, which is...
I'm predictable. I'm telling you, I have to change my profession now.
So overemphasizing the importance of foreign institutional investors could overlook this fact that historically there's been domestic finance. But that said, with this project, what we would like to do is to bring our work on institutional investors, on channels that they use, and on their perspectives on what they're looking for in investments, and learn some interesting things today about perceptions and maybe managing those, adjusting those. But also networks of institutional investors that attend our events, our Forum on Green Finance and Investment, this high-level breakfast that we have at the COPs for institutional investors. Always a lot of interest, many things that we've heard said over and over. There is increasing interest in this area, although if you look globally at renewable energy investment, there's not a dramatic increase last year. There's a huge amount of capacity. So there are different numbers that are used, but there are different ways to attract them. Investment channels, partnerships, de-risking, all of these are important. International Solar Alliance, working together with them.
Now, before I move to CPI, since you have invoked CPI, I'm going to move to Dhruba. But let me just ask you one more question, because you have you didn't respond to that particular question that I'd asked. The role of these big funds, pension funds, insurance funds, and of course you have amongst your stakeholders in your conversations a number of actors who represent them. What is the mood there? And I'm only asking for a perception. How do they see their engagement in the emerging markets, and especially in the green infrastructure asset class?
There's increasing attention and pressure sometimes put on themselves in this context to actually deliver these investments. And I think the shortage is, are there fund structures that allow for taking different parties to take on risks that they can properly take on? A small example, very small example, is the Danish Climate Investment Fund. There, the government worked closely with pension funds, and that's sort of helpful in the country where there's close relationships, and pension regulators are very familiar with the pensions and with the financial regulators. They came up with a structure with a first loss provision to enable this sort of investment. It's relatively small scale, but that concept seems to be valid for other uses.
Let's move to Dhruba. I think you've been invoked, and you've been, the CPI study has been mentioned, and of course you have an experience with the IFC as well. So I think you have been dealing with some of the key infrastructure issues around smart cities and energy options. Both the IFC experience and the CPI study of the CPI had, how do you assess opportunities of using these different public finance institutions, MDBs, and of course crowding in private investments and new investors?
Thanks, Amir. After the excellent inputs from Rathin, Kanika, and Robert, let me just step back. I mean, I would not start at the macro level, which I think Rathin has brought it out excellently. Kanika has delved into the micro level, and Robert has talked about kind of external interventions which could be done. But I would draw your attention to 3 or 4 terms which I'll pick up. One is in your report, which is high risk, which I saw in your report. Essentially, the word highly risky. We hear that a number of times. Now let's understand. I hear de-risking. I hear risk mitigation. I hear credit enhancement. So I just want to lay here 2 simple points. If you have to de-risk, if you have to risk mitigate, if you have to credit enhance, these are what we see as measures that everybody wants. What does everybody want? As Rathin mentioned, savings, they are there. They happen to be there. Then you have trillions on what? It's about 118 trillion sitting in institutional investor. You want that money to intermediate, savings should get intermediate to climate investment. Institutional investors should invest. There is an issue of risk, which is like a kind of all-encompassing term. My two simple questions, and I think this will give you some pointers of public role, which you asked me right now in the question is, how do you credit enhance if you do not know the credit quality? One. How many entities, enterprises? India has a potential of 400 gigawatt on rooftops. The target is 40 gigawatt. We are struggling at 2 gigawatt, right? These entities, the sun does not discriminate between who owns the roofs. What is it that we don't have? How do you risk mitigate? How do you credit enhance? Because if you do not measure it and if you do not know it, what is a public institution? I'll draw Kanika's point here. What is a public institution's role? What is the measure of risk? Do you know the credit quality? Do we know? No. How many entities are all rating agencies put together have credit rated? We rely on credit rating, it is 1 lakh. How many enterprises are there in India registered? 25 million against 1 lakh credit rated entities. So we have a problem of information. What is a guarantee going to do? A guarantee is not about, I heard Robert mention, poor credit quality is not what it is supposed. A guarantee is not for poor credit quality. Its guarantee is meant, or a credit enhancement is meant for something you do not know today. If you credit enhance, the credit will flow. Tomorrow you will have information, you will know it better. So let's start with getting these institutional information in place, which will make finance as a market failure is a proven thing. It does not work like real sector. It's classic market failure. Moral hazard been mentioned. You start with adverse selection, you'll come to moral hazards, you'll have one crisis after the other. So you will need regulation over there. So to correct the credit market failure, you'll need regulation. Now the regulator, I was there the other day trying to talk in RBI, Cafral Institute of opening a session on sustainable climate finance for all the banks. Now what RBI, which Rathin mentioned too, is that RBI role, mine is macroprudential financial stability. Great, I don't want to take this role. So we have a point there, I just want to park it, the regulation. The second issue, first issue which I mentioned was of information. So what will I risk mitigate if I don't know the quality of risk, and how do I measure this? This is a key point to be understood. Now let me come to the issue of money. Now we want money to come in at lower interest rates because the price of money, as Kanika says, needs to be lower. Now what is price of money? What is price of money if I look at it, whether it is foreign exchange risk or whether it is domestic or foreign capital? Let me come to very, let's say, very basic levels and very arithmetic, elementary arithmetic. A price of money is the price of time value of money, which I can't do anything, you can't do anything, government can't do anything about. It will be the time value of money which you will have to, it will keep varying here and there and it will go. After that, what does the lender or the investor load in? A price of a risk that you know. What does he use? An institution called credit rating. He comes up in credit rating that determines the price of known risk. But there is another animal in the story, is you have to set aside capital to take care of unknown black swans which can happen. Now that is determined by the regulator. Now we say that the money is not going to flow in because these three things are determined exogenously, and therefore the money has to flow in, and therefore I need to improve. So once we can move these institutions, once we can recognize, and I want to make one last point. It is probably not accepted by all stakeholders that whenever I come across climate investments, whenever I come across low carbon, clean energy, it is high risk. Now the whole issue is risk high there, or is the risk high if I fund a coal-fired plant? Is climate risk not getting factored in? So who is responsible here? And I think your report brings that out, and it mentions Basel III, but I'll get into that discussion later. But there is a merit in trying to understand whether these links are, whether climate is high risk or low risk. Are we getting it fundamentally wrong? And somewhere I was talking to
But
Rathin.
I think,
Sorry, thanks.
let me just ask you a pointed question. When you say, are we getting it fundamentally wrong, who is the we here? Is it the various group of stakeholders, or is it the way we in India are creating an ecosystem? I think that's important.
I think it's all stakeholders that we see. In fact, today morning I was reading a report from Brookings which says that low carbon infrastructure is high risk, and therefore if I invest in low carbon climate resilient infrastructure is high risk. Is it really a high risk, or are we not thinking about the problem of saying, is climate risk a part of credit risk? Now I'll give you a simple example. Rating agencies are coming up with credit ratings, they're keeping green ratings separate. The green is not entering the credit rating
That's
framework,
right.
not entering the framework inside. So I'll give you a green rating. If you are good on green, I'll give you a rating. You are AAA on green, but you are BBB on credit. So will the investor invest in you, in your instrument? So I have a problem there.
So I think that's the point I was getting to. I think you are absolutely correct that there is there's a underrepresentation of real climate risk in the credit risk, and I think there is a fundamental shortcoming of the way we are currently moving money. And in case we were able to do that, you might also see that certain regulatory uncertainties may not look that highly priced if the real climate uncertainties were placed alongside. Yeah, I think you should push back on this. Yeah.
Very important point. But remember one thing about ratings, it's a zero-sum game. So the real question you've got to ask is, if they incorporate 5 or 6 or 7% green into their ratings, what are they going to get rid of? That's extremely important for me to know. And I don't get an answer.
No, yeah, point taken. But I'm saying, so 2-3 things. One is, get the information right. Let's get the information. We don't have the information, and we are trying to go risk mitigation. Point
I think that's a very valid point, that we don't even understand the landscape, so how are we going to de-risk or enhance credit?
Let us reduce reliance, a blind reliance on rating. Let me put it that way. It's like saying, okay, as long as it doesn't really care, as long as you're AAA, AA, you go in and let's talk to, I have tried speaking to PFRDA, your long-term pension funds, PFRDA in India. I'm not really glowing, I'm not informed enough maybe globally, but it is a global issue.
It's a
when
global
I talk about this issue is global. Without taking it, the question is, I need to protect citizens' hard-earned taxpayers' money. So therefore, very, very laudable objective. The question is, can I not do a part of that allocation, at least what you do? Now, it's a challenge really. How do we get it right? How do we really look at bending the curve in the future? Because if you're not going to bend the curve in the future, I think financial sector regulators have a key role to play, because finance is a case of market failure as always, and you'll have financial sector regulators have a key role.
And I think that's a fair point, and that takes me to Pankaj. See, you assess environmental risk at the IDBI. IDFC. He is saying that there has to be a more central role in the way we organize the flow of money and we assess risks generally. An environment must play a factor in that. How is your experience been in this on this particular aspect, and generally how is infrastructure finance bank in India pricing these various conversations, or incorporating these various conversations into their operations?
Within IDFC, we tried to just include this environmental risk in our rating process. But because in some cases, environment risk is very high, so that and weightage definitely will be low on the environment side, not a very high side. So as Dhruba mentioned that if a AAA company and environmental risk is high, so how we can just degrade the rating within our appraisal process. So we tried to just include this parameter in our rating system, but we thought this will not work. So that's why we separately assess the environment risk in our...
That's the point you make.
Yeah.
I want to just add, sorry to interrupt over here, but it's important to recognize that we need to differentiate between compliance, which you are saying, which is absolutely required. It is about compliance to environmental and social safeguards, which is your... But the question is, is it providing an incentive? You rightly said you're not factoring in, you're keeping it separate. Okay, I just want to make
No, no, I understood. I think he's
and
confirmed the point.
measure.
He's confirmed the point.
So,
I also have a follow-up question. So if a company has a low general rating,
yeah.
a low environmental risk rating and a high general rating, do they get money cheaper because they have a low environmental risk rating, or do you just
No, they don't.
We are the private sector.
I can
right?
confirm to you they don't.
We can, yeah.
So you only punish them if
Yeah.
the environmental is high.
Yeah, that is actually environment risk
I mean,
is
you know,
part
it.
of
I
that.
think you're making a point here. I think
Yeah.
knows it.
I got the point. I just asked.
So, in the environment risk, we just follow the parallel system. So, along with our appraisal note, there is a separate environmental due diligence report, and which is having the equal weightage. But we don't include the rating in the rating system.
You want to, the mic is there, Kanika.
Equal weightage to drive investment choice or investment decision. Equal weightage for what?
So equal weightage means if any high, because we categorize in critical, high, medium, low risk category with respect to environment and
I
social.
understand. And so you will submit one environment risk report and one fiscal risk or whatever.
Yeah,
it
yeah,
was,
yeah,
right?
yeah.
And then you said they have equal weightage in driving investment decision.
Yeah, so that goes to our approving authority.
So you mean to say that suppose your environmental risk is low, you will not get a discount, but if the environmental risk is high, you may not get the money at all.
Yeah,
That's what you're saying.
yeah.
Yeah. So I mean, fair enough. I think that's how it works. That's how I understand the system to be working. Go ahead. Sorry.
But if we are getting some concession rate, because we have a couple of credit lines from IFC, climate change, JBIC, and we are also in the advanced stage of GCF accreditation. So, we can pass on the benefit to the clients, but our risk appraisal system is the same for these type of the things. So there is no if environment risk is low and other credit risk is high, so there is no difference in this.
And the credit lines that you have now available because of, say, interest in funding green infrastructure, say that you took some names, JBIC and others, is the cost of capital lower for those credit lines?
Yeah.
So it's cost of low. So you are getting a discount and you pass that discount to your client. That's what you were basically mentioning. Okay. Rathin, you wanted to, I think, come in on something Dhruba or Robert was saying. Because I could see a bemused look on your...
No, not what they were saying. Let me first say the thank you for this very honest, and I've struggled for years to get this from someone in the business. So there you have it. And this is why we have an institutional failure. There's nothing I can do about it, except game you, which is say that, it's great that we have green bonds, as you almost laid out. I'm only interested in green. I'm not from the environment community or anything, because I want more money. And if you want to give it to me cheaper because I'm putting it in railways, fine. So just like he's saying, so what are you getting here? You're getting the international community doing credit subvention, which he as a sort of intermediary is taking and passing on. I don't think you pass all of it on, but passing on some of it to the retail client if they invest in a certain area. So basically what you're then getting, please understand this, is central planning. Global central planning in the one area is remarkable. It fails in terrorism, it fails in tax, it fails in other virtuous things. But here, environmental agencies have decided, like Jesuits do, that, let's give money cheaper for green, which means you don't give money cheaper for something else, like, milk for babies, helping refugees in Nigeria, because that's not fashionable. So you give money for green, and then you give it to a bank cheaper, and because it is cheaper, they lend it cheaper. Nothing to do with the risk portfolio. No, I had a few points. I mean, there was an interesting point that emerged here, which is another example of the kind of institutional leap of imagination the global community needs to make. Which is, so if the multilateral banks actually start doing what you said they should do or could do, it is extremely likely, it is almost certain, I can't say it because I've not done the study, that if they go to scale doing it, they will lose the one thing that developing countries prize to date, which is their AAA. So now the policy question becomes, are you going to be happy? I'm saying if it happens, are you socially happy with the fact that when banks come in and absorb, let's take one thing that you mentioned so nicely, absorb exchange risk. African Development Bank absorbs exchange rate or political risk. It is quite likely that they will have a higher failure rate to that risk absorption. If those risks made any sense at all, if you've lucked out and the risks were bullshit, it's fine. But suppose the world was right and Africa is a nasty place, then that nasty place will have more failures. And more failures means you lose your AAA. and you lose your AAA means everybody else's expense
Goes up.
in terms of cost of capital goes up. So that becomes then a global community decision. Are you willing to accept, what do you want to do? Do you want a lower rating or do you want to change the terms and conditions of the rating? Right, the second point I wanted to make, sorry, you want to comment on this?
You want to comment?
Yeah. So the second point I wanted to make was something that you mentioned, which is very interesting. So you're right. I'm sure your econometric studies picked up ease of doing business, laundry list of things, because that is true of all investment. So that is not particularly my problem. Then we are not discussing investment in a low carbon economy or infra. We are discussing investment in nasty places, which have bad ease of doing business ratings.
Correct.
Right, and then we can talk about how we make nasty places nice, and I have some ideas there. But I mean, I would put to you that given the level of per capita income in my country, and given the decrepit nature of our society, and all the things that we read about in the papers, we do a pretty good job of governance. It's far better than 1850s Russia or 1890s UK. So but we're not rewarded for that. So never mind, that's a separate conversation. But in that, I would also like to say that there's one important point that emerged from what you said, which is about domestic savings. See, I want to make a macro point to you, if I may, which is when I'm X minus M deficient, my problem is not what happens with domestic savings, and I'm certainly not into the business of telling domestic savings how it should allocate. If it wants to go to government, let it go to government. If it wants to go to informal, let it go to informal. I'm actually in the game only because I'm interested in shifting savings where old people earn them, which is in the OECD.
Correct.
To where young people exist, which is here. That's my mega problem. That is why I run a fiscal deficit. I don't have export-led growth. The old game was I sell stuff
Correct.
to people who can buy them in the OECD. The new game is I sell stuff to my people, but I finance that by giving old people in the OECD a rate of return. So that, I think, is the problem that perhaps you may wish to explore. And the final point I want to make is I want just the audience to note how interesting it is that despite all of us agreeing that fixed income is important, we have ended up spending 80% of our time talking about banking.
Correct. Absolutely.
Nobody's fault.
Dhruba, I think you wanted to respond, and then I'll come to you, Robert. Okay, go ahead. And Kanika, then I'll come to you, because you've been invoked a few times. Your name, Kanika. It's on. Go ahead.
So it's an excellent point. Rathin, the issue is, as you said, if you put all multilaterals together, they can't find, their balance sheets are not big enough to finance India's infrastructure or Asia's infrastructure needs. I mean, no way. So therefore, there are small balance sheets backed up by callable capital of good rated countries. I'm not undermining rating completely. Now, whether the ability of multilateral institutions to borrow in global capital markets at low cost is what AAA signifies. The issue is, instead of I lending $1 to one brick of the road, because everybody is driven by what can I lend to India. India has already borrowed 17 billion, 15 billion from ADB, so whatever the numbers may mean. But by the way, India is the largest borrower from the World Bank, and that has been for years. Before IFC, I was in the World Bank. So the issue is, if I used to use this capital and this balance sheet, let's understand that the World Bank does not differentiate between sovereign risk of countries. South Sudan and India get it at the same rate. So India is a good rated BBB, mid BBB country. Now, if I were to use the multilateral balance sheet to be able to crowd in OECD capital from UK and OECD capital, and let an institution create an institution in the UK which is a better jurisdiction of doing business, and that problem is not there, then I have an issuance which can be supported by multilateral guarantees, and your capital comes in here. So let's use it to leverage and magnify a smaller balance sheet by use of better instruments of guarantees at the sovereign level. So when Wall Street money wants to come in, and somebody was talking to me, okay, so 250 basis points because you are India, BBB country. So I add 250 basis points first before I look at it. So I need to reduce that risk first also, the sovereign risk of the money, because in clean energy and climate, your cost of money becomes the determinant. So if I can innovatively think of structuring a financial institution, supra-sovereign, which can then use a World Bank guarantee, and that money borrowed in an OECD
so let me get this clear, because I think
I could extend myself to say RBI, instead of putting it in US Treasury, which is a triple B country, could put its...
So you're saying
bond
because,
issuance.
say, the World Bank does not see the sovereign risk differently for different countries, if they were the first lender, can I crowd in other finance
Exactly.
for these
That's what
projects?
I'm trying to say.
In fact, what he's saying is interesting. Let me give you some numbers just to make it clear. I was having this conversation with investors in Hong Kong on Friday, and they're very worried about this oil price rising and our BOP will go bust. And I said, how much do you think we have at the back? They said $400 billion. I said, wrong. We have $400 billion in the RBI, all in US Treasury, or most of it. We have $200 billion. We have $100 billion with the Bank of Japan, which can be leveraged double. That's $600 billion. And my Indian companies have $250 billion worth of assets abroad. I was just trying to scare them. So I said, you jewelers sit in Hong Kong and try and short me. I'll make sure that 3 generations of you don't have money to eat. So, because we have $1 trillion behind us. But that $1 trillion is lying idle. So I completely agree.
So that's the point he's making. Robert, you wanted to come in.
Yes, I just want to go back to this question of risk and how do you price risk and how do you de-risk if you don't know what the risk is. So the question is data. And,
Correct.
and for investors and thinking about crowding an investment in the space, increasing, scaling up, what matters is the risk return profile of these projects when it comes down to it. And there's a number of levers that affect that. Government policies to date, you have a feed-in tariff, you have that supports for a while, then it becomes competitive, you have an auction, and increasingly competitive. This is good. On the risk side, what are the reasons for risks in, let's say, renewable energy investment here? You're struggling at 2, you need to get to 40, then beyond that to 400. So actually understanding what those risks are from the perspective of your target investors, that's critical. And then, so you need to collect the data, share it with the investors, and at the same time, because you don't want to create this moral hazard, and because you're not addressing the problem, you have to actually work with policymakers to see what can be done to change it, whether it has to do with the discoms, whether it has to do with land, and very challenging problems that don't go away with the snap of the finger, but you do the two at the same time. So that's a response on that issue. And also figuring out, appropriate de-risking approaches. Like I said, CPI has done a lot of very interesting work. It has very specific suggestions on how to address a particular kind of risk, and that'll reduce X in the cost of capital. Super interesting. Who can take that on? What institution here, because presumably you're talking about domestic institutions, you're talking about IRETA, talking about others who can do that, who is mandated to do that. So that's one aspect. And the other thing I want to say is this question about institutional failure, about not costing the risk of climate. I think we're talking about climate resilience in infrastructure. And there, it's worth mentioning that there's this task force on financial disclosure. Europe is moving forward with their action plan on sustainable finance. There's the central bank network on sustainable finance. They're beginning to think about this question about how do you cost in physical risk of climate. So we all say, all infrastructure has to be climate resilient, but how do you cost that out? How do you make that something in a sustainability report, environmental risk assessment? How do you actually make that financial and include financial returns? And that's not something that's institutional failure in India alone. That's the world trying to catch up with that now.
Okay, I think that's a valid point, and I suspect that task force, and I think there's also a conversation at the G20 and the T20. Certainly at Argentina, we were hearing conversations around this. I think this is something that's going to build a little bit of momentum in the days ahead. I am just worried that you are going to crowd out certain money into certain sectors, and I'm more worried about the crowding out that will take place rather than the directions. And I suspect the emerging markets might be at the wrong end of that crowding out. So again, it's something to be very careful about before we implement that. Pankaj, you wanted to come in, and Kanika, I want to come to you before I open it up for Q&A.
So just let me add one thing. In India, if you see, there is no this environmental risk assessment system in the banking industry. So IDFC is the only bank who is signatory to Equator Principles and follows the IFC performance standard in our appraisal system. But this is a competition market. If we appraise any project and other banks are the consortium as there, so we face a lot of trouble, sometimes internally, sometimes from the client side, that nobody is asking why you are worried for these things. So I think if we ask for this low carbon economy pathway, where international finance is very much required, so there is a requirement, as Ms. Kedwai mentioned yesterday, that there is a requirement for the Indianized some principles for the bank, environmental principles for the bank, for risk assessment process.
Yeah,
so
we
that
need an equator principle equivalent to assess climate risk, or to at least also define what is green. You know, you were mentioning these bonds are bonds. You can remove the green and put T in front of it, it's still a bond. You know, so it's a new... That's right.
So, and this definition is definitely required. If you ask about the SME sector or MSME sector, so as Kanika mentioned that transaction is a very low, small transaction, and transaction cost will be high. So, and awareness is very low, because it state to state in Gujarat, there are so many awareness is there. They are aware with this green financing. But in the other states, it's very difficult to just for the capacity building and awareness, these things are required. And if some policy level decision on the just what is green, what is the low carbon thing, how industry developer can get the benefits, so we can just avoid these barriers for this low carbon financing in India.
Thanks, Pankaj. Kanika. It's open, it's open. It's on.
Hello. I speak very loudly so you can hear me.
Hello. This works.
Okay, thank you. So I wanted to come in on a few points, but first, since Dhruba gave us
It
a
won't work
little-
from that distance. That would be a miracle. Yeah, a miracle.
Since Dhruba gave us a little what do the word meanings at the start of his first intervention, I'd like to say that de-risking in and of itself is a misnomer.
Correct.
There is risk sharing. You don't de-risk anything until you have systemic solutions. And with green infrastructure in general, and renewables and energy efficiency in specific, we feel like if we make broad top-level policy, that's enough. And then after that, we don't need to do any other systemic corrections or upgradations to actually see the realization of these targets that we've set for ourselves. And in the green bond world as well, we will target 1 trillion issuance of green bond. How? How are you going to do that?
Every time you target green bonds, Rathin gets uncomfortable.
There's more money coming from green bonds.
Okay.
So regardless, but the railways doesn't know what to do with it. They don't know what all qualifies
Okay, so
as
green bond session is after 5 o'clock.
So I think that we need to think a little bit about risk sharing and what are the systemic solutions, all of which are not going to be financial. And that's when a lot of these innovative ideas that Dhruba and Rathin were discussing, but also other ideas that CPI has come up with or that we're working on, the World Bank is working on, they need to also be thought of with a sunset clause. They cannot exist forevermore. And that's the problem with MIGA as well, right? That you came up with an instrument that you never thought would be used enough. And so the MIGA has never had a default, ever. Because they're so conservative in the way they use it. So it's really actually, the world with or without MIGA is not much better off, with the exception of a few people feel comfortable in lending because there's a MIGA guarantee. And of course, this isn't, it doesn't make for very popular panel comments, but it's the truth.
No, but MIGA is also certainly, the extremely limited use of MIGA is not going to respond to the large flows.
No, sure. I mean, it's not even just for green infrastructure. But that aside, I think that we need to think of innovative ways, but with sunset clauses, with systemic corrections. And that really is the point that Rob was making around data and green banks. Around the world, we see that there is a risk perception delta, so the risk perceived is greater than the real risk. And that delta can, in part, be sorted out with data, but also a lot of times that data exists, but we're not necessarily, it's not accessible, or there's also a hesitance to access it, because it's just, often small scale, or I'm not sure, I don't have diversity, whatever. But on the green bank point, I think that green banks or any green lending from public financial institutions is really important, so that what Rathin was saying does not happen, so that we're not cutting public money that should be used for nutrition or whatever else, because green banks are not supposed to use taxpayer or tax money for doing project finance.
Okay. Rathin, do you want to come in? You want a quick intervention? Go ahead. Yeah, go ahead.
So
Do you
on
want
that,
to?
on that point,
Yeah.
Yep.
Go ahead.
So the data that I talked about, our database, we found that, 64 transactions out of 151 involved the UK Green Investment Bank, which is amazing given all the other institutions. Another thing that's worth mentioning is that something that we call transaction enablers. So there's de-risking. That's the short version for risk mitigation, transfer, and sharing. It doesn't go away. The transaction enabler that was used 64% of the time was co-investment. No subsidy there.
Exactly.
And that was the approach, actually, not to keep on talking about UK Green Investment Bank, which doesn't exist in its previous form now anyway, but continues in private form. But there's a lot that can be done without concessional finance to get over these risk deltas through demonstration effect. So that's the main point. Thanks.
Perception and the black box assessment of ratings, the process, you have spoken about it in the past, and I think she has touched on that.
Yeah, I just want to make the point that actually, I don't know what de-risking means, but certainly reducing the risk premium on a developing country project has to do with lowering the weight that you assign to certain kinds of risk which are qualitative in nature. To that extent, there's a game in de-risking, which is different from the game of transferring a given amount of risk to another balance sheet. So both need to proceed. On the first involves global political action, which has failed. The second involves an increase in the scope of activities that we've been speaking of, and that is, I think, where we'll go.
But I think that first part is equally important. So there is a question of the perceptional risk. When you remove that, you're actually reducing the quantum of risk that you are attaching to any movement of capital.
Yeah, and also remember that risk affects Walmart less than it does an infra project.
Correct.
So Walmart gets money for
At
the
a
same
cheaper
level
rate.
of risk at 150 basis points, 200 basis points less than where we want money. So it's something that has to be solved politically. But as I said, the trouble in Basel and all that, given the state of the world, is everyone is trying to reduce stuff by hobbling you with more and more premium.
So let me take a couple of questions. You can add it to the response to the closing. You want to do it right now immediately on
Yes.
this? Go ahead.
One other thing is when we're calculating risk premiums, and I'm not sure how you do this at IDFC, but we double count risk variables. And is there a way that we can all collectively decide not to do that? Because why should the person who's borrowing have to pay for the same risk premium or risk variable that comes in the form of different risk premiums more than once? So how do you address that at IDFC?
Do you want to respond to that?
Actually, this is not the double risk premium, because this is a part of the single appraisal of the single project only, or simple corporate only. So we are not, because appraisal note is the same, but due to this, we are avoiding just to, if any critical thing is involved in the environmental risk assessment report, and weightage is not equal to the credit thing. So we don't want to merge that. So that's why this is equally important, and based on both the things, our authority just take the decision.
Okay, so let me pick up a couple of questions. I think Aprajit wants to ask one. I have volunteered Geraldine. Anyone else wants to come in? But there you are. So we'll go to you as Rithvik, right? And anyone else? I'll take 3 or 4 questions. And sorry.
The green infrastructure is
Collapsed. Lack of capital. Anyways, so we will pick up 3 questions, and then we'll come back to the panelists for the responses and their final word on this subject. Okay, Aprajit, go ahead.
I'm not sure if it's quite kosher for BNC to ask a question, but I'm going to go ahead anyway.
As long as you don't sing a song and only ask a question, it's kosher.
So there was a couple of, Robert, I think you mentioned going off balance as a potential solution for some of the risks. I think that, Dhruba, you also mentioned supranational entities in other geographies. Both of those help reduce the geography risk, but they don't necessarily take care of the project finance risk, which Geraldine has written about. And the fact is that project finance risk, especially in this iteration of Basel, it's one of the most powerful disincentives for infrastructure investment and green investment. So what can be done about that?
Geraldine. No, just write down. Okay, Geraldine. I'll remind you.
Yeah, I was volunteered by Samir to ask a question. I really think that from an OECD perspective, we've seen a massive increase of interest from institutional investors in OECD countries in the past 12 months. It's really game-changing and it's happening much faster. They're really thinking how to integrate climate risk, and the conclusions they're going is there's not enough market depth for increasing green investment in OECD countries. So the conclusion is how can they penetrate emerging economy markets like India? So if we were to bring, hypothetically, OECD pension funds, asset managers, and insurance companies in India, in that room, what do you think are the key things that we need to work with regulators to make them invest? And I'll ask you a more refined question. Do you think that direct investment is the solution, or do you think that we need to think of innovative partnerships with banks and utilities? Let's say you can pick any sector. Thank you.
Anyone else?
So as of now, most of the countries, specifically as mentioned by Kanika, that institutional investors is something that we should be looking at, and how they can get involved in financing infrastructure in countries which require it. But do you think that as these institutional investors look at basic, the big three credit rating agencies for their specific feedback, as if they need to, if they want to invest in a certain country, and it's not the project whose risk rating these agencies provide. They provide risk ratings for the countries itself. So for specifically for countries like India, which has a population of 1.3 billion people, and investment which has already happened over here over the years. This is not about environmental investment, but a lot of investment which has happened over the past 70 years of the history of this country. Do you think that the current ESG factors which are involved in creating the credit rating for these countries, is it enough to actually provide an instance or an understanding of what kind of risk these countries are at?
Okay. So the Basel disincentives, the conversation with the pension and insurance funds from Europe, how do we create a regulatory landscape to make them invest? Is direct investment the option? And finally, the last question that all of you heard. I think we can just go down the panel, and we can all take a minute and a half to respond to all or either of them. I'm generous. I've always been generous. So you can take 2 minutes, Kanika. You get 2 minutes. Okay? So go ahead.
Okay, so Aparajit, you asked a question about project finance risk. So just to go back, I was talking about how later on with the development of the green bond market, if you have more securitization and you have more project-based bonds, whether it's bundling bonds in different forms, the interest there is from sort of a financial instrument point of view. So thinking of investors, right? Thinking of institutional investors. Now, if the World Bank issues a green bond, then you're investing in the green bank. You're not really investing in the bonds. Project bonds are relatively limited. In the future, if you discover that you collect data and you find that, well, the performance of bonds that aggregate loans for electric vehicle batteries or leases, actually the performance is really quite good, and then you invest in the bond, and that's it. You have the data there, and then the performance of that bond in the market is different. It's based on what these projects actually do. That is interesting. Right now, green bonds are priced like vanilla bonds, and so it's not particularly interesting as an investment product. So that's the future of that market. That's the potential here. Getting into broader questions of risks, I'd just go back to previous comments. It's understanding what those risks are. There's a difference. There's a question about whether there's faulty risk perceptions that should be addressed. They have to also think about how they can break into these markets. And I go back to what Geraldine was saying, which was very well put. That's what we're trying to do with this project, among other things. Working with the government on the policy areas, and with you, because you're the experts here, is to actually identify the policy changes that are possible within a short amount of time that actually would make a difference. And so for that requires some thinking and then some political will. So we'd have to work with government and with all stakeholders, but also on the stakeholder side for bringing investors here, what would you say to them? What are the right investment channels, vehicles? What, if any, is the role of de-risking in the short version of that word? Who can take that, who's in a position to take that on? Because in the end, you do have to have a compelling investment proposal to get them to invest. But actually, if you bring them here, you give them the data and the information, then hopefully that will reduce some of the barriers and you strengthen this ecosystem.
Good. So you skip the Basel part, but I'm going to make Rathin respond to that one.
Okay.
Dhruba. Oh, you can do the Basel as well. And go ahead.
So should I?
Yeah, go ahead.
No, I'll just keep it short. I mean, you're right, but Basel 2.3, there's no change apart from it. See, Basel as such discriminates infrastructure project finance. So it's not about clean energy. So that remains the issue. But I'll link it to the other question, which I think is very important. How going outside the country solves the problem, I'll link it to what Robert was saying. See, the risks in India of the wider economic environment of contract enforcement being poor, rule of law being patchy, you have a problem of sanctity of contracts, you have a higher political risk. Now all these get factored into the price. So when I create an institution which is in a jurisdiction which is different, but the challenge here remains that if global capital needs to address climate, which is a global public good, and it is easier to address in OECD countries, the capital will go to OECD countries and will not come to emerging countries, and therefore a supra-sovereign solution may be a possible way out, where I have a stock of foreign exchange reserves, high savings. It's extremely important to recognize that Asian countries have high infrastructure deficit, when all Asian countries are high savings, and these savings are invested in US Treasury bonds. So let's look at getting those global financial flows changed. I'm not an expert. Rathin may be able to comment better, but that's the key. So I'm looking at a very micro level, create an institution, use that better jurisdiction, get the capital, let that capital come here.
I'm sorry,
I think,
can I just respond for one
Project, we are closing up now. We are closing up now. Rathin, for you, as a comment was raised yesterday by a couple of speakers, that the gearing ratio, using our savings and creating instruments. And I think we've kind of missed that element in terms of creating a greater depth in our own markets to be able to create instruments that respond to any of these needs. And I think that's the point he raised, that we've not yet literally been able to leverage our own savings. No. I mean, if the camera is Chatham House, then it's Chatham House? No, it's open. No, it's going to be put out. It's going to be put out. It's open. So say the real thing now. Kanika, go ahead.
Thank you. So I think between Dhruba and what Rathin's going to say, most bit upright than Rick's questions will be answered, so I'll answer Geraldine's. So I think I want to pick up on something that Pankaj was saying before about preferential lines of credit that are being received, and this is in response to should we think of some innovative partnerships. And so my answer would be that we definitely need the pension funds of the OECD to come into India, but let them not partner with the banks. And I'm sorry for saying that, Pankaj, but the reason for that is there is a lot of preferential lines of credit that are being routed through banks, whether they're public banks or private banks. And what that is doing is that the banks are actually, A, taking a little bit of a premium to manage that money, B, they're not doing that investment from the rest of their pot of money, and C, they're only putting that money in the most obvious projects, which are so that they don't actually, I mean, of course, they're, like he said, they're private banks, they have balance sheet concerns, they don't, and they do big, large transactions, and so make their life easy, disperse the money, and that's it.
Not routed through any bank or public sector banks?
Any banks is what I would say. But that being said, there is, that does not mean that they can, that these...
Other than IDFC, they are, IDBI, they are...
So I think that this institutional investors need to come in, and they obviously can't do it alone. There is, of course, going to be a need for collaboration for, say, first loss tranches or other innovative de-risking mechanisms, which we will determine based on the state of the sector at that time. But there is, it's important that they come in and then make a lot of this bank debt, which is currently tied up in this project finance, available for other sectors, especially the MSME, which we were discussing briefly in the beginning. So.
Rathin.
thanks. I don't know. You see, there's something wrong in our country that she's not in the Ministry of Finance. There's something seriously wrong with the way we hire people. Anyway, so it's not going to change. No, you can't have lateral entry now. So, okay. The first point I think about project finance risk and Basel. This is the wrong time to be having this conversation because my central bank is paranoid. So that conversation is not going to happen for a while. The point about the OECD, I'd say there are three guiding principles here. One is that we do have a BBB rating, whether it's green, black, blue or brown. And we think that BBB rating understates what we have to sell. However, we do recognize, this is what I would tell the OECD, not the OECD is too big, not the Japanese are a different conversation. We already do. But you know, chains and that sort of thing. We really want here.
With the Japanese, we have a Chatham House conversation.
With the Japanese, we have SoftBank.
SoftBank.
So, and you know, with the Koreans, we have, you know. But the others, you know, the Norwegian pension fund and all the very important pension funds, these are, the Scandinavians have lots of pensions, so we need that money here. So I would say that is one. Two, I'd say, however, recognize there are three cutting-edge risks which repeatedly come up, which I think we will need a public intervention to sort out. And here I'm transgressing Chatham House rules but let me say that hypothetically, if one were to be asked one's advice, then one would suggest that one do three things, which is possibly without bringing in a financial crisis into context, to provide assurance, as we often do informally to our own investors, that India's exchange rate is going to depreciate because the rupee is overvalued. And we have the renminbi to worry about, but what we are aiming at is an orderly depreciation. And you should be able to buy financial advice which tells you by how much the rupee will depreciate with an orderly depreciation, that is without exogenous shock. And that hedge is a much cheaper hedge than a hedge where you're constantly looking for exogenous shocks. I would earnestly implore these very well, analytically endowed pension funds to go and look for those hedges. And then I could possibly commit that over and beyond that, if there was volatility, then we could come up with a product. So that is conversation one. Conversation two would be, we recognize that we have imperfection of contracts, and I'm really going to transgress Chatham House rules, but let me try not to. And it may be worthwhile exploring possibilities of having broader jurisdiction locations should disputes arise of certain types than are currently the case, which may also include locating deal making in jurisdictions other than possibly the jurisdictions that concern the two countries that are negotiating such projects and where the pension fund may be located and operating without prejudice to government policy on that account. If you didn't understand that, I'll tell you in the coffee break. And the third risk, of course, is the land risk. And that will have to be sorted out on a case-by-case basis. So those are the three. On savings leverage, I completely agree. It's interesting that we have begun doing this with equity. So what the NIIF is trying to do, it is just beginning to be reasonably successful, is leverage 1/7 into equities from global markets. It's working. It's working. That's one domestic rupee sovereign at the moment. And what we want to do eventually is over the next 7 or 10 years, replace that sovereign rupee with domestic savings. There's no particular reason why we could not do it for bonds, except the missing link by expertise. I've been working on this, but I don't have a solution yet. Is what I said at the beginning, that how do I make more fuzzy the distinction between a sovereign bond or a quasi-sovereign one and a private bond to broaden the bond markets. Now, the railway green bond gives me, oddly enough, an opportunity to do that. Although it's a London bond, if I'm able to develop product, and this is why I'm quite happy the railways don't know what to do with the money. Because if they could then act, because the IRFC that's taken the bond. So if they can bring that money into the financial markets to finance things like wagon companies and coal companies and coal. Because or cleaning up coal that they use. That's also a good use of the money. Bad
word. We move to.
And anyway, it's all green because electricity is green, right? Compared to diesel, so we are going to put it all into electricity. So that's cool. But you don't want the railways to think like that. You actually want them to think about productive investment. So that is, I think, where that juxtaposition would be best done. Develop the bond markets. Work with people abroad who are willing to come into the bond markets, but on our part, we have to recognize that since our bond market is sovereign driven, how we make that sovereign, non-sovereign distinction more fuzzy. It means more innovations on the part of the sovereign, it means more tagging, and it means more securitization. There's a lot of work going on that at the moment in the Ministry of Finance. So I think in the long run, the conversation will have to move into how we get your pension fund
to invest in fixed income product here? Thanks.
Last word.
Yeah. So I would like to respond on this direct and indirect investment. Actually, we have a mix of experience. For example, IFC is there, number of multilateral agencies are there. They have some direct investment, but it takes too much time because they first identify with the who will be the developer, what type of the project, and because international standards are very robust, and what are the major gaps and how the developer can bridge these gaps. So these things are very difficult for the multilateral agencies just to identify and bridge these gaps. So it takes a lot of time. As per our experience, it takes about 8 to 10 months just to appraise one deal, one project. But at the same time, if there is a indirect investment through any financial institutions, so because that international agency, multilateral agencies just appraise the bank or financial institution, what is the capacity just to handle their this type of line of credit, and this is our requirement, and they just identify the gaps. So it takes hardly 3 to 4 months, I think so. And once a bank identify, okay, such type of the project can be mobilized in this credit line or this fund. So because bank have a very client oriented person, we have the project where viability gap fundings are there. We have the project which are not viable due to this low cost funding. So we have already rejected a few cases in past, so that we can easily identify such type of the projects and mobilize the money immediately. So in our experience with the IFC as well as ADB and other multilateral agencies, it took a lot of time with our appraisal process, but when we got the fund, because we know what is the requirement, and easily we can mobilize the thing. It takes hardly 3 to 4 months just to exhaust entire the credit line.
Thank you, Pankaj. So I think with this, we'll close this particular conversation. Please join me in thanking the panelists for their fantastic insights. And Rathin, now you can explain to Geraldine both your fascination with coal and and with the caveat that you had included. Thank you very much. Please join me in applauding the panelists.